Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is totally part of that effort. Today, we've got our conversation with Chris Zhang. Chris is my partner and CIO of the family office. He's got an incredible depth of financial knowledge and market knowledge for those who haven't heard him talk before. He spent too many years as a derivative trader at Morgan Stanley before doing this. It's a general market catch-up, but we cover a bunch of things. The impact of the debt ceiling. There is some different signal coming out of the equity market and the bond market, and so there's a bit of a dichotomy. Chris tries to interpret what those signals mean about expectations for the future. We talk about also what's happening in the crypto world, right? There's some action against some of the large crypto companies, and we're watching a very long-term journey of crypto finding its way to be integrated into the financial ecosystem. So I think probably good intentions on both sides, but a lot of work and tumultuousness probably to come in that kind of navigation. So anyway, I think it's a good sesh. If you're interested in the markets, here you go. What's up, Chris? How you doing, man?
What's up, Mark?
Well, look, this might be your last one for a bit. I know you're doing this monthly, but for everyone listening, he's about to have his first child. So they're in like 11:47 p.m. of the day of baby gestation. I don't know where this metaphor is going. Anyway, how are you holding up?
I'm doing okay in general, and just to prop myself up, this is my Mark Peter Davis Day. For those of you who are listening, this is what Mark looks like on a day-to-day. A little less handsome, but otherwise about the same.
I'll take the compliment.
Overall,
you're referencing your hoodie.
Correct.
I'm like a black T-shirt, hoodie. Although I'm trying to up my polo game. A lot more polos.
Funny. Risa told me the exact same thing. I need to do that.
Yeah, I'm trying to polo, just kind of like classy casual. That's the old man vibe I'm going for now, because I can't pull off the 27-year-old punk rocker anymore. It's out.
Yeah, that's right. And baby stuff is good. I am as ready as I can be. Let's see. Hopefully, I'll be back in no time and talk to everybody about markets.
There we go. All right. Well, let's jump in. So we're now in this new cadence. It's been a month since we've had you on. Last time you hit China.
Yep.
You gave that overview. It was awesome. A lot of people listened to that and were pinging me and talking about it. The big thing that's happened since then is the debt ceiling cycle. We're on the back end of it. Seems like it's sorted for this lap. Did anything, outside of the news thread on the negotiation and bickering and whatever else, did anything substantial come out of the new bills?
Yeah. We can talk about this for an hour. We in fact had an internal chat, as you know, about debt ceiling for quite a long time, and I'm not going to talk about details, but there are a few implications and takeaways from it. Number one, we have not solved any fundamental issue as a country, meaning the budget. How do we balance the budget? This is simply kicking the can down the road, and in this scenario, it's about 2 years, less than 2 years. This is right after the next debt ceiling talk is going to start pretty much when the new president or the same president takes the office in 2024. And we're going to go at this one more time. And this bill made it even more difficult for the one coming up to pass through. I'm sure everyone's been following the news. There's been a lot of infighting and cross-party fighting. I mean, it's not a good scenario. Everyone sort of seemed to compromise, and no one's happy, right? So we'll see what happens with McCarthy and leaders on both parties, and chances are the fight is going to be even bigger next time. The one thing I think people need to pay attention to, and it's probably the least talked about in mainstream media, is the compromise around social welfare. Just to sort of think about this topic globally, we sort of saw what happened in France earlier this year, last year, when they tried to hike the retirement age and decrease social benefits. This has always been, I mean, it makes sense. You know, people have been working 30, 40 years and save up for retirement and counting on the government for welfare. And the government has to take something away because about that the budget is not balanced. This is a very triggering topic, and there's no happy medium. Someone's going to sacrifice. So any move the government has with regards to social welfare and benefits and retirements is going to be what potentially causes the next wave of risk events and protests, and it's going to be hotly debated, and it likely will affect the longer term future of this country regarding immigration, just overall happiness and productivity, right? So that's something I really do think cannot be overlooked, and such an essential part of budget and just the well-being of this country.
Any ripple effect you see from the legislation that you're like, okay, in the next 6 months, it's going to push the needle left or right?
With regards to markets or in terms
market
of policies? Yeah. So look, the stock, the one thing, first of all, let's talk about some two different things, because the stock market and the bond market has behaved so differently through all of this and before and after. The stock markets, the public stock markets have been behaving extremely well, very calm into the debt ceiling, a little bit of volatility, range bound between, I'm talking about S&P 4100 and 4200. And immediately after debt ceiling has sort of had this relief rally a little bit, and we're up about 5% on the index level over past months. But that's not really the only story. What you see behind the scenes and what people maybe care less about, or at least monitor less, is the bond market, which has been trending the opposite way this whole time. And there's this clear dichotomy between the two markets, where the bond market thinks that we're still in this inflationary cycle. The Fed is going to hike maybe one more time, and we're going to actually stay put, meaning no cuts coming in the next year or two. And the treasuries, and then the one thing we talked about before was just the treasury curve, the 2s and 10s, right? The difference between the 2 points have been very negative for over a year now, and is still very negative in and out of this debt ceiling talk. Meanwhile, the equities just keep rallying, right? Like stock markets just keep being very confident. Both markets, it's important to know, are supposedly forward-looking, right? The stock price you see today is supposed to reflect what people think, what market participants think 6 months, 9 months down the road. Same thing goes for the bond market. So in a way, if you read this, equity participants are saying we're good. We're no more risk events in the near term. Earnings are strong. Tech is leading the rally. We're back to where we were. Okay, no more COVID. The bond market is saying, actually, no. The economy is weakening. People are spending less. The Fed has to spending less, but but at a slower pace than expected. So we're still in an inflationary cycle. The Fed has to accommodate and hike rates, and the economy is going to crash, right? So people are saying two different things, and one of them has to be right, or maybe both are wrong. Who knows, right? But historically, right, in times like these, we can only look at history and see who has been more right. It's been the bond market that's been more right historically. And case in point, the one thing that we can immediately go back to is, okay, let's talk about the most recent cycle. What happened in the sort of the crash in the market in 2022 and COVID. And if you really look at and just put the two graphs on top of each other, S&P versus Treasury 2s and 10s, leading up to the beginning of 2022, there's been this flattening of the curve already, right? In 2021, we're at 2s and 10s the differential is about 1.5%. By the end of the year, we're already at around 80 basis points. So it's a 70 basis point drop, which is, again, this indicator, 2s and 10s, is sort of a bonds market sentiment gauge, if you will, right? How people think the longer term versus the shorter term will play out. And it's negative in the bond market. But if you look at stock market leading up to 2022, we're at historical highs. And it's like nothing bad has ever happened. Life is good. And we all know what happened afterwards. So
right, but we know the stock market's got a lot of emotional decision making in the buys.
mhm.
We
Yep.
know that. It's just the energy of the crowd. The
Yeah.
bond market, I would assume there's a reason why, just to take what you said, that it's usually been more right or more correct. I would imagine that it's because the investors behind that are generally more institutional, right? And so
Yeah.
you've got less emotion, and I'm sure there's emotion still, but less emotion, overarching, just emotional flow. So the
Yeah.
question is, if the bond market is the signal to look at, and the bond market is thumbs down,
Yeah.
what is it saying? Is it saying the creditworthiness of the U.S. is going to go down? There's going to be more inflation. What is it signaling? What's driving that shape of the curve?
Yeah. What you just said makes sense. Absolutely. It's sort of more sentiment driven in stock market, more so compared to bond market. Another layer to that is also macro versus micro, right? So historically, the Fed interest rate doesn't really play a role, or is not supposed to play a role in your company profitability across the entire economy. It will affect certain sectors and this and that. But this cycle has been different because the move is so dramatic, it affects every single sector. So bonds market are more macro, equity markets is more micro, but now macro is dominating micro in a way, right? That's why I think in this cycle in particular, I think the bond market has been more right. And going back to your real question, which is what is this really signaling? If bond market is correct, then we're basically still in an inflationary cycle, and the long-term credit worthiness of the U.S. Treasuries and U.S. bond market and is going down, as evidenced by the rising interest rate in the longer dated part of the curve. If you look at 10-year Treasury, we're back at the highs. And specifically on the back of this whole debt ceiling talk, the confidence of for global market participants in the U.S. economy is still there. Just to be clear, right? We're still doing incredibly well on global stage, but has been decreasing. That confidence level has been decreasing over the past few months, and certainly in a trend over the past few years, going lower. And you can also see that in other pockets of the market too. If you look at currency, if you look at sort of really just trade, international trade, and you look at the rise of other currencies, and we talk about China in particular, but the importance of U.S. economy on the global stage is still there. Don't get me wrong, but it's steadily decreasing, and that's
waning.
really the long-term future that we really care about.
This is such an interesting moment in time, because you've got this very clearly waning U.S. economic power, at least until management tries to fix the financial problems that we have. Problem is we have bad management, right? But at the same time, right now the SEC is kind of going after all of the crypto and blockchain companies. All the big names are kind of getting attacked and going after them. What's interesting about that to me is that I think while the US is the reserve currency globally, while the dollar is the main store of value around the world, man, blockchain, crypto, crypto particularly, not blockchain, is threatening to the control and the levers that the US government has, right? They can impose sanctions and penalties and do stuff if they have reserve currency status. But the interesting thing is, while the US is in the process of losing control, if we don't right the ship, if we don't get good management in to run the country, and by the way, I don't think either party is good management, right? If we don't have someone who's operating fundamentally differently than either party is thinking right now, the US is going to want cryptocurrency. Wouldn't you think? Like if China's currency becomes the global currency, right? Then you want crypto, because what it's doing is it's gutting the power of the reserve currency country. So you don't want crypto around strategically when you are the reserve currency, but when someone else has it, crypto sounds great. So I wonder if there's it's this incongruous. We're not balancing the budget, right? Historical cycles and patterns suggest we're going to lose reserve currency status because our government's not going to get their shit together. And at the same time, they're trying to kind of undermine the thing that will undermine the other currency when it takes reserve currency status. So unravel that.
Yeah. Impossible to unravel that, but let me just say that it's still too early to tell, right? This currency war, who's going to be the winner, including crypto. I mean, my view has always been that we're at the early innings of this, and let the market dictate who's going to be the winner. But every government's going to try to step in and insert themselves. But market always wins at the end, hopefully, at least in the West, let's say. But back to your question, look, crypto is, or blockchain in general, we've all been supporters of this. And SEC coming after, a few companies, as we've heard in the news, their main argument, let's start from there, is not crypto is bad, blockchain is bad. It's the players in those markets could be nefarious, and they could definitely create harm, let's say, on the general populace who don't really understand the market. So their argument is we need to make sure that if there are certain things like cryptocurrencies that behave like securities and transact like securities and carry the same functions like securities, they need to be registered as securities. And as a result, be monitored by the government, right? That's the core of their main argument. The reason why they're going after, these companies. But I totally get it. The other point of view, which is, look, the whole point of cryptocurrency is so that it doesn't get regulated and it's distributed and it's, controlled by the people. So it's the same debate as usual, which is how much do you care about protecting the mom and pops, the little guys, the commoners, the us of the world, our interests, the people who don't understand necessarily, don't pay enough attention to the market, protect our rights, our safety and privacy, versus making sure this is a completely free, distributed, sort of additive world. Who knows? I don't know. I don't know the right answer to this.
Two parts of this that I'm hearing you say. One is the narrative I've been hearing is the opposite. It's that the crypto companies want to be officially regulated.
Yep.
And what they're doing is they're being told they're out of compliance, but they're not being given an option to be in compliance, and they want to be regulated and in compliance. That's my understanding. That might be wrong. Now, maybe that's what they're saying, but they're not acting. I don't know. I'm probably
the part that they cannot be
at the mercy of headlines.
The part that, exactly to your point, the part that they cannot really be in compliance is the registration of securities, right? Imagine Bitcoin has to be registered as a stock, right? Like, and that's impossible. That defeats the whole point of Bitcoin. So what do you do? I don't know the answer to that.
They need to make laws to sort out. Yeah, it's going to be complicated. The second piece, which I think is more of a macro policy that kind of trends beyond crypto, is the government has generally said as a philosophy, if something is complicated, we're not going to let people with less wealth buy it. And I think they're using wealth as a proxy for intelligence.
Yep.
And sophistication, which doesn't hold to
Agreed.
be. And I think it serves to promote asymmetric opportunities. Right? There's look, we're in venture capital, right? Venture capital, when you get with the right firms, is a wonderful, high-performing asset class. But accredited investor laws and a bunch of these laws don't allow people with normal incomes to buy into these assets. And that doesn't feel great to me, because I know what we're capable of yielding and the kind of money we make people. And I would love for other people to be able to participate in that. Not just limited to the wealthier institutions. Now, the one good thing is the institutions are usually representing the rest of the population. If it's a retirement fund and we're managing their money and we make the money, well, we're creating wealth for everyone, all the retirees coming out of that system. So that's the good thing. That's where it's working. But I wish there was, I don't have all the answers, of course. Just got a lot of questions and some bad opinions. But I wish there was a more egalitarian, more flat way to give access to these investment opportunities.
Agreed. I couldn't agree more there. I'm registered with the SEC. I know the law. I know the rules. I know what their main goal is trying to protect. But to me, at the same time, the reality is that the number one contributor to economic inequality is access. And to your point, credit investors, qualified purchasers, these are all defined by your net worth, your existing investments in the space, and it doesn't make much sense. And basically, it comes down to the richer you are, the better access you have. Well, how does that make sense? So,
right. What if you're a PhD student studying rocket science or economics, and you have no money? You're not allowed to buy into funds that you could probably understand better than I could by 10.
Mm-hmm.
Doesn't make sense. Now, maybe that's an edge case I'm coming up with.
Mm-hmm.
But people can get ripped off in any of these things. This is the problem, right? Like I call this the butter knife problem. It's a butter knife. It can cut butter, it can kill you. Right? Depends on how it's used. It's a tool. Fire's the same thing. Cooks your food or kills you. Burns your house down. These securities, the public securities are regulated, but there is bad behavior within those companies. There's information asymmetry for sure.
Mm-hmm.
Right? And alternative assets are the same. There are bad actors. Most of the people are not. And so it's this butter knife issue of, we're telling everyone they can't cut their butter, which is, I think, distressing. People like butter.
Yeah, it's a good analogy. What else we got?
That's it, man. It's a good little sesh, good catch up. Good luck with Baby Sitch. I'm guessing we're going to catch you on the other side of that. And a quick reminder for everybody, Chris is an SEC registered RIA, so nothing he said should be construed as investment advice.
Thanks, Mark. Talk to you soon.
All right. Always awesome to have Chris on. Thanks, everyone, for listening. We are coming up on our summer break. Hasn't happened yet, but we've got a couple more episodes coming up. And then Will tell me when it's time for me to tell everyone that we're on pause. But we'll be back next week with more content. If you have any questions, if there's anything we can ever help with, you can get me on Twitter @MPD. Hope everyone's well. Good weekend.